All right, good evening and welcome to Atlantic Federal Credit Union's Credit Score Seminar. Our goal tonight is to help you unravel the mystery behind your credit score and to help provide you with the knowledge to take control of your financial future. My name is Leah Villasis and I'm the Consumer Lending Manager here at the Credit Union. And I'm also joined this evening by Emily. Emily, would you like to take a quick moment to introduce yourself?
Emily Hamilton and the vice.
I think we lost you there for a second, Emily. Did you want to try again?
Oh no, can you hear me now?
I think we can. Yes, go ahead.
Hi everyone. Apologies for that technical difficulty. My name is Emily Hamilton and I'm the Vice President of Consumer and Mortgage Lending here at Atlantic.
Wonderful. Thank you. Emily is going to be joining us closer to the end to assist with some Q&A. So we'll say goodbye to her for now. All right, so as we go through the presentation, if you have any questions, you can click on the Ask a Question button to submit your questions. We are going to take some time at the end to try and answer as many as possible. So with that, let's get started. Where does a credit score even come from? Well, there are three major credit reporting agencies or bureaus known as Experian, TransUnion, and Equifax. Each individual bureau uses their own unique formula to create a credit score, and this often can be the reason you may have a different score depending on where that score is coming from. Each individual lender or financial institution is able to choose the agency that they prefer. And while all lenders and financial institutions rely on the information from your credit report and your score to decision a loan, the way that we lend or look at loans here at Atlantic is a little bit different. And we're going to touch on that piece a bit later on. Within each bureau, there are multiple different scoring models. TransUnion, for example, has over 10 different scoring models. So for this reason, you can find that institutions or lenders might provide different scores even though they're using the same agency or bureau. The most common scoring models you'll hear about are FICO scores or Vantage scores. And here at Atlantic, we use a Vantage scoring model. Now, your credit report is made up of different types of accounts or what are typically known as trade lines. And your trade lines are split into two different categories, revolving loans and installment loans. An example of a revolving loan would be a credit card, line of credit, or even a home equity line of credit. These accounts or trade lines don't always have an end date, and the monthly payment amount can vary. You can borrow from them, pay them down, borrow from them, pay them down, and you can use them over and over again. An example of an installment loan would be mortgages, home equity loans, auto loans, student loans, and even personal loans. Very different from the revolving loan, as these have a specific start and an end date and a set monthly payment. Now, accounts that are not paid at all, or maybe accounts that are paid late, are considered to be derogatory accounts. If you have a bill or a loan that is sent to a collection agency, it's considered derogatory. Repossessions and bankruptcies will also report negatively as derogatory accounts. We've talked so far about the different credit reporting agencies, as well as what types of accounts or trade lines that are reporting. Now let's look at some items that don't typically show up on a credit report. Items such as utility bills, rental, lease payments, cell phone and insurance bills, these won't report as a trade line even if you pay on them perfectly. Those same items, however, can show up as derogatory accounts if they're not paid or sent to collection agencies. While these items would not help to increase your score, they certainly can cause a decrease in your score if they're not paid. Once you have a few accounts or trade lines opened, your actual score is compiled of a few different things. Depending on which model is being used, whether that's a FICO or a Vantage model, the weight of these will differ slightly. So taking a look at a FICO score, your payment history holds the most weight. This is relative to on-time payments versus late payments. Capacity, or how much of a balance you carry on your credit cards, makes up the second biggest bucket at 30% of your score. And we're going to circle back on exactly what capacity means in a couple slides. The type of credit, having a good mix of both revolving and installment loans, will make up roughly 10% of your score. New credit or newly opened accounts will make up another 10% of your score. And lastly, the length of credit, or how long you've had credit history overall, makes up 15% of your score. Now, when we look at what a Vantage score is made up of, here we're going to see some very similar themes as the FICO score. The biggest difference here is that there's a new bucket called current credit balances. You'll notice that with both scoring models, payment history and credit card capacity still makes up the two largest pieces of your credit score. With Vantage, length and type of credit is combined and makes up about 21% of your score. Current credit card balances represents about 11%, and rounding out that last 5% of your score is new credit and new inquiries. Now I want to circle back to capacity. Capacity makes up a big part of your credit score. Capacity is all about how much you have in total credit card limits. So we'll look at an example. If you have a credit card with a $1,000 limit and you spend $500, you've used half or 50% of your total capacity. Now, what does this mean for your credit score? You will lose about 50 points off your score by using 50% of your total capacity. So let's say that you started with a 650 credit score. By spending that same $500, you could have dropped your score down by 50 points to 600. The good news about capacity is that once you pay that balance back down, your score will quickly go back up roughly those same 50 points. So paying down your credit card balances is the single fastest way to improve your credit score. So now that we know what's on a credit report and what your score is made up of, what does that score mean and what is even considered a good score? Credit scores range from a low of 350 up to 850. Now, each lender may look at scores a bit differently, but generally speaking, a good score is considered anything 600 or higher. And credit scores of 730 and higher will most likely get you the best possible rates available. There are some key things to avoid when it comes to building your credit. And these items can cause your score to drop and sometimes drop very fast. Late payments can really do some damage, and a single late payment can drop your score anywhere from 60 to 100 points. Those points can often take as long as 12 to 18 months just to get back. Each hard inquiry or opening or closing an account can drop your score another 4 to 7 points. Speaking of inquiries, there is a significant difference between what we call a soft pull and a hard pull. A soft pull is not associated with a lending decision, but it is commonly used by some employers, insurance agencies, sometimes even a landlord, simply to review your credit. And a soft inquiry does not affect your credit score. A hard inquiry, though, is an inquiry into your overall credit history to determine whether you manage your existing accounts responsibly. These can lower your score, again, about 4 to 7 points. Keeping your credit card balances high can also hurt your credit score. You'll lose approximately 1 point for every 1% of your card usage. With that said, though, credit cards are a necessary part of your credit score. Keep in mind, just because you have a credit card does not mean you have to use it regularly or even keep a balance on it. Repossessions are difficult for any lender or financial institution to ignore on a credit report. And many people don't realize that when your vehicle is repossessed, you still need to pay the remaining balance, even when you don't have that car. On the positive side of things, there are some things you can do to help increase your score. Paying down revolving lines or credit cards is the single fastest way to boost a credit score. Just like carrying a high balance on them will decrease your score, paying them down, as close to zero as possible will help increase your score. Pay your bills on time, every time. By creating a monthly budget or setting up automatic payments, you can help ensure that your bills are paid on time. You'll also want to have a good mixture of both revolving loans and installment loans. Ideally, having a minimum of 4 different accounts or trade lines is best. And lastly, time. Building your score does take time, and what's most influential on your credit report is the last 2 years of recent credit history. So I want to take you through a real-world example of how your credit score can make all the difference. A good or even great credit score is more than just a number, and it can sometimes save you thousands of dollars. So we're going to take a look at 2 members and how their credit score affects the way they each pay for a loan. Member A and Member B are both shopping for the exact same vehicle, priced at $25,000, and they're both looking at a 72-month term. And the only difference between them is their credit scores. Member A has a credit score of 731, which qualifies them for a rate of 6.49%. Member B has a credit score of 635, which is still considered a good score, but qualifies them for a much higher rate of 14.49%. Let's look at the monthly payment. Member A has a payment of $420.25 a month, but Member B is going to pay $100 more a month, again, for the same exact vehicle. Why? All because their credit score is lower. What's more eye-opening is the interest these 2 members will pay over time. With the lower rate of 6.49%, Member A will pay $5,257.20 in interest on the life of their loan, while Member B is going to pay over $12,500 for the same exact vehicle. That is the power of a credit score. Here at Atlantic, we want to help you do better and help you save money. And our loan specialists can help you learn how to build and maintain your credit score so that you can pay less and get the best possible rates on all of your loans. When it comes to making a loan decision, we don't just look at the credit score. We want to hear the real life story, the what happened, and even the why. We know that every story matters and our mission to change lives for the better. So how do you get started in building or repairing your credit? Atlantic wants to help. You have the ability to reach out to our experts through video banking, applying online on our website, visiting any one of our 10 branches, or by speaking with a loan specialist over the phone. You can even keep an eye on what is currently reporting by signing up for Savvy Money through Digital Banking by Atlantic, which can also help you monitor your credit. Atlantic's goal is to help you do better because a better credit score will lead to better rates, which we believe will lead to a better future and a better life. At this time, this does conclude the presentation on improving credit. We are going to invite Emily Hamilton back and see if there's any questions out there.
While we wait for a few to roll in, I have some questions that people asked when they signed up, if you mind going over those.
Absolutely.
This is a big one. Do you have tips on how to pay down my credit card balances?
This is a great question. So in the presentation, I talked about credit cards being the single fastest way to pay down or to increase your credit score. Sometimes a great tip can be starting with the lowest balance and making that minimum payment every single month. And let's say, for example, that minimum payment is $50. So once that card is paid in full, then let's tackle the next lowest balance. And you're going to pay that minimum and then add that $50 that you were paying on the other one. This can help pay down your credit cards a lot faster and definitely clean that up for you. Great question.
I would also add to that another way that Atlantic can support members to pay down their debt fairly quickly is through something called a debt consolidation loan, where we can take those balances and pop them into one loan, which has a very similar effect once you change the loan type from that revolving account into the installment loan.
So I know how to improve my credit score now, but what do I need a credit score for?
I can take that one. Credit scores are really used primarily as a way to price loans. We look at the correlation between credit score and what the interest rate should be, and those are really go hand in hand. It's a good indicator of payment performance when looking at a loan. I will say at Atlantic, we look so far beyond the score because everybody has a story and everyone has a history to what they're doing. And we really go through your credit report with you, but ultimately they are used for pricing the loan.
Thank you very much. We have one from the chat. They asked, what is the best way to get your 3 credit reports?
Yeah, so there's a couple of ways that you can do that. There is a website that is available to the public. It's annualcreditreport.com. And then you can access once a year a free copy of your credit report. It doesn't typically include the score, but you can get a copy from each bureau there. Also, anytime you apply for a loan, you are eligible for a free copy. And there you can ask for the information to be able to obtain that. And then through digital banking by Atlantic, we also offer Savvy Money, which will at least give you a copy of your TransUnion credit report. But those are a few different ways that you can get a copy of your credit report.
What can I do to keep my score high once I've paid everything off?
The advice I typically give people to keep their credit score active is to have an account, at least a credit card account that maybe they every 6 months. Make sure that it stays open and active, and that will keep your credit score active. When you have no debt for at least a 6-month period, no open accounts, your credit score goes to 0. So even just having one credit card open that you use very occasionally is going to keep that credit score active.
What do I need to do to qualify for a mortgage?
A couple tips I give people when they're looking to qualify for a mortgage. First of all, I would say your credit score is fairly important. A lot of mortgage products do have minimum credit score requirements. I typically advise people to try to get north of 660 to just give themselves as many options as possible when applying for a mortgage. Doesn't mean if your credit score is below 660, we can't help you, but it's nice to have different products so you can have the best product for you, and having a higher credit score can help with that. So you try to tell people, try to get it above 660 if you can. Try to keep your debt as low as possible. There are certain income ratios that we pull in order to qualify people for mortgages. So keeping your income down, paying down your credit card is a great way to accomplish both of those things. And the last piece of advice I give people is save money. Try to save for a down payment. Try to save for closing costs. Get yourself financially ready for a big move like getting a mortgage.
A person in the chat here mentioned that a bank did a hard inquiry on their credit score twice on accident. What can you do if there's errors on your report or a institution messed up like that?
I guess there's a couple things that I would answer this one with. I'll say first of all, one of the consumer protections that are out there for your credit score is that if a like institution pulls your credit report, does a hard inquiry within a 45-day window multiple times, it will only count as one pull to your credit. And that's because consumers are allowed to shop around for credit. So if you go to a dealership, for example, and try to obtain financing there, and they send your information out to multiple institutions, it's really only going to affect your credit score one time because you're allowed to do that shopping So there's a consumer protection on that. If it's within a 45-day window, it should only count as one inquiry, even if it shows as multiple. The actual impact of your score should only be one time. The other piece of advice I give people is if there's anything on your credit report that is inaccurate, you are allowed to dispute all credit information directly with the credit bureau. All 3 credit bureaus have a way to file a dispute right online, right on their very own website, Experian.com, TransUnion.com, Equifax.com. You can complete a dispute process and they'll work with you to get those resolved.
It's looking like we don't have any more questions. So if anyone doesn't want to ask anything right now, I think we might wrap this up. All right. Thank you very much for joining us, everyone. There will be a recording of the presentation if you want to go back and check anything. And thank you for joining us, and we hope you have a wonderful evening.